Welcome to the Depth Dive. We're tackling a big one today, the global insurance scene, really digging into McKinsey's 2025 report.
Yeah, there's a lot in there.
Definitely. Think of this as your shortcut, really. Our mission is to pull out the most important bits about growth, where the opportunities are, and also the big challenges across personal, commercial, life insurance, the whole spectrum.
We spent some time sifting through it all.
Exactly, to bring you the need-to-know stuff. And right off the bat, the report paints a picture of, well, a pretty volatile time for insurers, doesn't it?
It really does. They call it a volatile age.
Mm.
And you can see why macroeconomic uncertainty, geopolitical shifts, changing trade patterns, it's a lot to navigate.
A complex backdrop, for sure.
But interestingly, despite all that turbulence, the report actually strikes quite an optimistic note. It points to some significant opportunities for, profitable growth, even now.
Okay, so let's unpack that. Maybe start with the insurance most of us deal with day to day, personal P&C, car, home insurance, that sort of thing. The report mentions some big growth numbers there.
Absolutely. Globally, personal property and casualty premiums, they jumped quite a bit.
Yeah.
9.5% in 2022-23, hitting $1.1 trillion.
Wow, 9.5%. That's significant.
It is. And interestingly, that growth actually nudged ahead of global GDP growth just slightly, by about half a percentage point.
But digging into that growth, it wasn't necessarily because loads more people suddenly got insured, right? What was driving it?
That's the crucial thing to understand, especially in the more mature markets. Think North America, Western Europe. A big chunk of that increase came from rate hikes. Insurers charging more for the same coverage.
Ah, okay. So premiums up, but maybe not relevance.
Exactly. In fact, if you look at personal lines insurance as a slice of the total global economy, it's actually still below pre-pandemic levels. It was 1.2% of global GDP back in 2019, but only 1.0% in 2023.
So the pie isn't necessarily getting bigger relative to the economy.
Right. And another point the report makes is that the difference in insurance coverage between those mature economies and emerging ones, well, that gap has actually widened.
So existing customers in developed countries are paying more, but we're not seeing a huge expansion into new risks or customers there. And that sounds like it's really hitting affordability, especially somewhere like the U.S.
Precisely. You've got rising asset values, homes are worth more. You've got higher repair costs, parts, labor, everything costs more. And then, critically, the cost of reinsurance.
That's insurance for the insurers, right?
Exactly. That
Yeah.
cost has soared. All these things combine, and yeah, insurance just feels a lot more expensive for people. The report gives a stark example. U.S. home insurance cost about 1.0% of household income in 2019. By 2023, 1.2%?
That might not sound huge, but it adds up.
It really does. And get this, the price for U.S. home reinsurance doubled, completely doubled between 2018 and 2023. Those costs inevitably trickle down.
Doubled. Wow. Okay, but it's not all doom and gloom. The report did flag some regions with potential, didn't it? Like Latin America, Asia.
Yes, definitely. Those are highlighted as potential growth pockets. And beyond geography, the report points to several big shifts creating opportunities. Think about the aging global population. Completely different risk profiles and needs emerge.
Right, different life stages.
Yeah. And changing buying habits? People buying cars or homes later in life? Then there's new mobility, EVs, shared cars, and of course the physical risks from climate change, natural disasters. Plus, underpinning everything, you've got technology like AI fundamentally changing things.
Let's pause on that mobility piece. EVs, driver assistance systems.
Yeah.
How is that changing the insurance game?
It's a big shift. ADAS advanced driver assistance systems are becoming standard. EV sales jumped, 35% globally in 2023. Though that pace might slow a bit, we expect EVs to be maybe 15% of vehicles by 2030.
Still a significant chunk.
Oh yeah, and partial automation could be in over a third of vehicles by then too. So the risk profile changes. Fewer small fender benders, maybe, but potentially more expensive repairs when something does go wrong with all that tech.
And you mentioned shared transport too?
Right. Ride-sharing, micromobility like e-scooters,
Yeah.
it's growing. And a lot of that insurance responsibility shifts towards the commercial side, away from personal auto policies. So for personal lines, it's about adapting, underwriting these new risks, creating new products. It's a challenge, but also an opportunity.
Makes sense. And the other big risk factor you mentioned, natural disasters, that seems unavoidable in the headlines these days.
It's a massive issue. The report had a really sobering statistic. Between 2016 and 2023, almost 70% 0% of global financial losses from natural disasters were uninsured.
70%. That's huge. How much money are we talking?
It averages out to about $260 billion a year in uninsured losses. Areas like Florida, parts of Italy, they're facing really acute problems.
So what are insurers doing? Just pulling out?
Some are restricting coverage, yes, but others are getting much more sophisticated with their underwriting, using better data, better models. They're also pushing risk mitigation efforts, helping homeowners make properties more resilient, and adjusting products. We're also seeing more talk about public-private partnerships to tackle these massive risks.
Okay, a multi-pronged response. Now, shifting gears slightly, let's look at the commercial side. Insurance for businesses. Strong growth there too, the report said. But a similar story underneath.
Exactly the same pattern, really. Commercial P&C premiums grew strongly, about 8% a year on average for the last 5 years, and profitability looked pretty good in 2023, an estimated average combined ratio of 91%. Remember, under 100% is profitable.
So healthy growth, healthy profits.
On the surface, yes.
Yeah.
But, just like personal lines, a lot of that premium growth was fueled by rate increases. And here's the kicker. Global composite commercial rates actually flattened out in the second quarter of 2024. First time in nearly 7 years.
Flattened. Okay, so the easy lever of just hiking rates might be disappearing.
It looks that way. Which means insurers can't just rely on price increases for growth anymore. They need to find other ways to grow profitably. It's about execution now.
Execution, meaning how they run the business.
Precisely. The report makes a really strong point here. How an insurer operates drives about 60% of its financial performance compared to where it operates, meaning which lines of business, which is about 40%, top performers just execute better.
60-40. That's a significant weighting on execution. So what does good execution look like in commercial insurance, according to the report?
They broke it down into 4 key drivers. First, clear strategies. Leaders know their value proposition, their risk appetite, where they're investing, and they communicate it. They're apparently twice as likely to have really clear public strategies.
Okay, clarity's key. What's second?
Distinctive capabilities. Basically being really good at something specific. Having a right to win. Maybe it's cyber insurance or a particular type of liability, like for private equity directors. We're also seeing growth in the E&S market excess and surplus lines for those harder to place risks.
So specialize or find a niche.
In many cases, yes. Third driver, navigating distribution. How the insurance actually gets sold. This is complex. Models like MGAs, managing general agents where the insured delegates underwriting authority, they're growing fast. 18% year-over-year premium growth in the U.S. recently.
MGAs, okay.
And insurer-broker relationships are critical. Digital tools are changing how businesses buy, too. But insurers also need to manage the quality of those distribution partners carefully.
Right, you need good partners. And the fourth driver?
Operational efficiency. Sounds obvious, maybe. But keeping admin costs low is crucial. Interestingly, though, even though top players have lower expense ratios, if you adjust for inflation and those big rate hikes we saw, the normalized ratios are actually higher than 5 years ago.
Higher, so they haven't cut costs enough to keep pace.
Essentially, yes. It means there's still a big need for genuine expense reduction. And that's where things like AI are starting to make a real difference, enabling efficiencies that weren't possible before.
AI coming into play again. What about investors? What do they want to see from these commercial insurers?
So they want that clear growth story we talked about. They're focusing on companies with a sustainable competitive edge. We're also seeing more alternative capital, like private equity, playing in this space. And interestingly, the share of long-term sort of fundamental investors in public commercial insurers has actually gone down.
So maybe more pressure for short-term results?
Could be.
Yeah.
It certainly puts pressure on insurers to really clearly articulate their strategy and demonstrate that operational effectiveness.
And technology's role in all this, particularly in underwriting.
Huge. Top performers are investing heavily in tech, better data, AI, machine learning, now Gen AI. It's all aimed at making underwriting smarter, faster, more consistent. And it's becoming an arms race for talent, too, attracting and keeping skilled underwriters who can use these new tools effectively.
Okay, makes sense. Let's pivot now to the last major area, life insurance and the retirement sector. The report sounded a bit different here, maybe less growth overall.
Yeah, it definitely a different picture compared to P&C. The life and retirement side is facing, well, somewhat stagnant demand in many core areas. A bit of a struggle for relevance, you could say.
Stagnant demand, even with things like aging populations.
Well, there are bright spots. Annuities did well in the U.S. in 2023, helped by the macroeconomic conditions, decent GDP growth. positive equity markets. Health insurance also showed strong growth globally, but traditional products like term life, endowment policies, they're flat or even shrinking in many big markets.
So a real mixed bag. What are the big forces shaping this part of the industry?
Demographics are absolutely key. That silver tsunami, the sheer number of people getting older. The 65-plus group is set to double by 2050 globally. Many countries are becoming super aged. That creates a massive need for retirement solutions.
A need, but maybe the industry isn't fully meeting it yet.
Well, the retirement savings gap, the difference between what people have saved and what they'll need is enormous, and it's growing. That's a huge societal challenge and an opportunity for insurers if they can crack it.
And other societal changes.
Yeah, changing family structures, different life paths. Traditional rigid policies don't always fit anymore. Flexibility is becoming more important. And customer experience, it's huge now. Good service drives sales and keeps people from lapsing their policies.
Mm.
But frankly, life insurance often lags other financial services here, especially on the digital side.
Interesting contrast, too. You mentioned market perceptions, public versus private investors.
Right. Publicly listed life insurers, even with okay results in 2023, they're kind of losing ground compared to banks or asset managers in investor eyes, often trading at a discount. But private capital, they seem much more optimistic, pouring money into the sector. And mutual insurers owned by policyholders, they're continuing to do well, gaining market share.
So private money sees opportunity where public markets are maybe skeptical. Where does the report suggest life insurers should look for growth beyond just selling more term life?
Several key avenues. First, really lean into retirement again. Higher interest rates actually make some protection and endowment products look more attractive for retirement planning than they did a few years ago. Capitalize on that uncertainty.
Okay, revisit retirement focus. What else?
Move towards integration. People increasingly want holistic solutions. So integrating life insurance with wealth management advice or with health-related services and insurance. Think broader financial wellness.
Breaking down the silos.
Exactly. Third, find new ways to serve customers and advisors. Better digital tools for advisors makes their life easier and helps them sell more effectively. Exploring new digital platforms, maybe partnerships or ecosystems to reach customers differently.
Improve the tools, explore new channels.
And finally, activate what the report calls the flywheel across insurance, asset management, and capital. Especially with higher rates, a strong asset management capability is a huge asset for a life insurer. Finding synergies there can create a lot of value.
Leveraging all parts of the business. Okay. So looking across all three, personal, commercial, life, it really feels like a time of, well, major transition. Big challenges, yes, but also some really interesting opportunities if insurers can adapt.
That sums it up perfectly.
Yeah.
The landscape is complex, it's shifting, but for insurers who are willing to innovate, who focus strategically, who really tune in to changing customer needs and market dynamics, there's definitely potential for growth.
But it's not about small creeks, is it?
No, the report strongly suggests that just sticking to the old playbook won't cut it. It's about embracing new tech, sometimes rethinking core business models. Being adaptable is probably the most critical capability right now.
The fascinating overview drawn from that McKinsey Global Insurance report. Really appreciate you walking us through it. So here's something for you, the listener, to think about. Considering all these trends, AI, climate risk, changing demographics, new business models, what's the most unexpected way you could see the insurance industry changing in the next few years? And what might that mean for you or for your business? Definitely some food for thought. Thanks for joining us for this deep dive.